welcome back to the third episode of Property School, which is where we basically go back to basics in the world of property. And today we are starting at the very beginning. We're going way, way back to what actually is a mortgage. We all talk about them. So many of us aspire to have one. But what are the basics of a mortgage? What actually is a mortgage? So let me introduce myself. I'm your teacher and property fairy godmother, Lexi Carducci. I am here to make property fun. That is my role. And kind of easy to understand by breaking it all down. There's so much that I wish that I knew 10 years ago, so I kind of want to share that with you. So what I know, as well as all the new things that I'm learning on a daily basis, because if you have listened to this podcast or if you've watched it before, you'll know that I don't think, although I brand myself as a property expert, I don't think anyone can be a complete expert in anything. There is always something new to learn. So there you go. I'm bringing you along with me on my property journey, and we can learn together along the way. So as a property finder, a developer and an investment landlord, that is what I do. That's my career. It is safe to say that my entire life pretty much revolves around property, day in, day out, and I wouldn't have it any other way. I absolutely love it, and that's why I wanted to share it with you as well, which is why Property School exists. So you could subscribe to my weekly lessons. It's free, don't worry, that made it sound like I was going to charge you, but no, it's free. Just something that I want to share with you. They're on IGTV, on Instagram, it's on YouTube, wherever you get your podcasts as well. You can watch, you can listen, however you you want to get involved. And make sure you do pay attention, because like any teacher, at the end of the class, I've got a little pop quiz for you, which I will give you a question based on what we're learning in the lesson today. I'll also reveal last week's answer later on in this show as well, so stay tuned for all of that. So before we start, I want to point out that I'm not a mortgage expert, I'm not a mortgage broker, I'm not a mortgage advisor, so do not take any of this as like legal advice, like you have to do this. This is how things should go. I'm just basically trying to break it down and simplify it and explain what I know about mortgages to help you understand them a little bit clearer, I hope. That's the aim. So let's kick off then. What actually is a mortgage? So a mortgage really is a loan that is used to finance property. Very few of us, I'd love to, but very few of us have cash that is sat around that we could actually pay cash for a property, because they're so expensive. It's like literally the most expensive thing that you'll buy in your lifetime. Yes, and none of us are really going to be able to afford to buy a property outright. So a mortgage, like any other loan, allows us to borrow money that we pay back, usually in instalments, plus interest on a monthly basis over a set time period. So we're really focusing on basic residential mortgages today. There are so many types of mortgages. I could go on forever. There's buy-to-let mortgages, there's first-time buyer mortgages, there's 95% mortgages, there's bad credit mortgages, there's discount mortgages, there's guarantor mortgages, help to buy, lifetime mortgages, mortgages for people kind of over 50. The list goes on and on. I would be here all day listing them. So my plan is to have a mortgage expert, fingers crossed, come and chat with us about other mortgages as well, particularly focusing on property investment as well, because I know a lot of you are interested in that. So like bridging loans, buy-to-lets, development finance, all of that I will cover in another episode. So stay tuned. Now, I mentioned interest there because first question is, how do the lenders make their money? I'm hearing you ask it. Basically, they make their money by charging interest, of course, for lending you the money. So as well as paying back the remainder of the value of the property after the deposit that you've borrowed, you will also be charged interest as well on top of that. That's why we hear people talk about interest rates so often and on mortgages, because they can vary a lot. So I'm going to go into that in a little bit more. So there's really two types of mortgages. There's repayment or interest only. A repayment mortgage is exactly like we just described, where you pay off the borrowed money plus interest on top of it. And then an interest only mortgage is just paying off the interest only. And at the end of the mortgage, you still have the amount that you borrowed originally left to pay in one massive chunk. So although you end up paying less on a monthly basis, because you're only paying the interest, not a monthly chunk of borrowed money, these can obviously be really, really risky, because you basically have to have a reliable financial plan in place to be able to pay off that big lump of sum of money at the end, which I guess if people were thinking, well, where would people, how are you suddenly going to get a load of money? I guess that could come from savings plans, inheritance, pensions, lucky windfall, or people would have to sell the property. But yeah, so we're really that's an interest-only mortgage. So we're really going to look at the repayment mortgages in a second. So I will get into those. But first of all, let's go through some more kind of frequently asked questions, some FAQs around mortgages. Now, I've put these together myself, kind of based on questions that I should have asked when I got my first mortgage. So here's a very quick story about my first mortgage. And this is just showing that we all learn. Do not be afraid to fail. I've done that for you, so I can teach you how not to do it. My very first mortgage, I actually didn't get accepted on because I messed it up. So they basically called me, so I did it through a mortgage broker. Then the lender calls me to kind of make sure that I am who I say I am and it's the right property. And I basically got the property address wrong. I was driving at the time when they called me, and I was so chilled. Like, the very first property that I got, it was on a buy-to-let mortgage. I wasn't buying it for myself to live in. It was to rent out. And I just didn't, if I'm honest, I didn't really know what I was doing. This had been recommended to me. I wasn't really listening. I thought other people were kind of looking after it for me and advising me on it. I had a lot of advice from my dad and my boyfriend, which is great because there's always going to be people that are wanting to help you, which is brilliant. But I just kind of left it to them, really. And I sat back, whereas I should have gone, guys, I want to know what I'm actually doing. Anyway, so I answered all these questions wrong, didn't know what I was talking about, and they went, she's dodge, we're not going to give her a mortgage. And I messed it up for myself. That's not ideal, is it? So don't do that. Know what you're doing. And what should have I done in that situation? I should have said to them plainly, I'm driving at the minute. It's not a suitable time to talk. Please, can you call me back later on? When I knew I would have been at home, I knew I could have got out my folder that had all this information in it, and I wouldn't have, just blasé it. I should have sat down and had a sensible conversation with them. Anyway, so I digress. I always digress. You've probably got to know that by now. But how do you go about getting a mortgage? We're going to look at some mortgage frequently asked questions. How do you go about even getting a mortgage? Where do you start? So there's really only two ways. Simple, you go direct to the lender, so like the bank or a building society, which you can find online, or you can use comparison sites, or alternatively, the second option is using a mortgage broker or a mortgage advisor who can go through options with you. I'd 100% recommend the latter. My mortgage broker is a lifesaver, just brings me mortgages I've never even heard of. It's brilliant. And it means that you don't have to do that yourself, and they know what they're talking about. They can bring you kind of the best deals. So I would 100% do that. It does cost you a little bit. I will go through some added costs at the end, okay? So another question, what happens if you fail to keep up your mortgage repayments? Well, ultimately, and worst case scenario in this situation, is that you lose your property. That's it. The property it is your property, but actually if you think about it technically, it belongs to the lender. They're the ones that have fronted most of the money. You've put in a little bit of a deposit. And the lender can repossess it if you fail to make those payments. Do make sure that you make your lender aware of any issues that you are having, though. Just be honest. Honesty is the best policy because they will always try and help you with a plan, a solution. You may be charged a late payment fee. It's obviously going to affect your credit score. So just be aware of all those things and do keep them up to date and in the know if you are having difficulties because they can provide you with help. Another question, where does the deposit come into this then? So we've talked about your repayments and things like that, but what about deposits? So usually you would get what's called a loan to value mortgage, which is known as an LTV. Remember this, it's all I'm saying. Remember that. Loan to value mortgage, LTV. So most residential mortgages are 90% loan to value, which means you borrow 90% of the value of the property and you put down a 10% deposit. So for example, if you were buying a £300,000 property, you would get a £270,000 loan to value mortgage, and then you'd put in the 10% deposit, which would be £30,000. On buy-to-let mortgages, they're a little bit different. They're usually a 75% loan to value, so you'd borrow 75% of the property value, and then you'd put in the remaining 25% deposit. So they do vary, but normally your average mortgage is 90% loan to value. You put in 10%. First-time buyer mortgages and Help to Buy, some of those are 95% loan to value, which means you only need to put in 5%, and then the government pays for the other 5%. But I'll cover that in another video because I don't want to go like off track. There's so much that I could say about mortgages, but I'm going to try and keep it like straightforward. So next kind of frequently asked question, how long does it take to pay off a mortgage? So this is called the term, and it can really vary, but an average term is about 25 years. So if you took out a mortgage this year in 2022, you would have paid it off in 2047. Like, no matter what the price you're paying, it will just, the value that you pay back every month will differ depending on what the price of the property is, but it would be set over that 25 years. Now, there are options for shorter or longer term mortgages, which can vary from 6 months, although they're not very common. I guess 2 to 5 years is a more kind of common shorter term, all the way up to 40 years, which would be classed as a longer term mortgage. There's a lot of varying factors as to if you would qualify for a shorter or longer term mortgage, and it's based on so many things: age, property value, deposit, credit score, income, and a mortgage advisor would definitely be able to go into more detail kind of based on your unique like personal circumstances. So that's another thing that they could help you with. So put simply though, a longer term mortgage means cheaper monthly payments because you are spreading that cost over more years. And if interest rates went up, it has less of an effect on monthly payments. However, they do work out more expensive in the long run because of the extra year's interest that you are paying back. And of course, it takes longer to pay back anyway. On the contrary, shorter term mortgages are the absolute reverse. So they work out cheaper overall and are quicker to pay off, but the monthly payments are higher. And if interest rates rise, it has more of an effect. So there you go. That's different length mortgages. Another kind of frequently asked question is, can the interest I pay change? Yes, absolutely. This is why people are always forever talking about interest rates so often. And it can affect the market, like the property market as well, and kind of vice versa. It's like a catch-22, I guess. So it can depend on what kind of mortgage you get. I'll talk you briefly through the kind of most common repayment mortgages. Remember, that's what we talked about at the beginning, where you pay back the borrowed amount and interest on top of that. So there's a fixed standard variable rate, which is known as an SVR. Remember that as well. I'm giving you little clues here. Or a tracker mortgage. So there's those three: fixed, standard variable rate, SVR, and tracker. So again, I'm not here to give legal advice. It's always best to do your own research or find for yourself, find the best mortgage, or to get a mortgage broker or advisor, which is always what I would recommend. So to kind of go into that, the interest rates are based on the Bank of England base rate, which sets the level of interest that banks and building societies charge borrowers. So as of the 16th of December 2021, it has increased to 0.25%. That's up from 0.1% that it was before. Obviously, that all had to do with COVID and everything when it was dropped, but now it is back to 0.25%. For reference, this is being filmed in January 2022, in case you're watching it at a later date and things have changed. So a fixed mortgage means that your interest rate is fixed at the same price for a certain length of time. So it would stay the same whether that base rate went up or down. Many people kind of take advantage of these kind of mortgages when rates are low. So usually fixed mortgage terms are between 1 and 10 years, with the most popular options being 2 or 5 years. Oh my gosh, I felt like I was going to fall off my chair there. Did you see me go like, whoa? It's good for budgeting and knowing exactly what you'll be paying every month. And if you know you won't be moving for a long period of time, it kind of works for you. That might tick those boxes. However, if you want to move or you want to remortgage within that fixed term, then you would normally have to pay a penalty known as an ERC, an early repayment charge. Remember that too. All these clues that I'm giving you as to what might be in our little test at the end of this episode. And those ERCs, those early repayment charges, can be very, very costly. So after that fixed term expires, you would usually revert to the lender's standard variable rate, SVR. So a standard variable rate mortgage next. This is the second one. That was a fixed rate that we just looked at there. This is the standard variable rate mortgage next that we're going to have a little look at. This is the standard interest rate that's charged by your lender, and it can vary month on month. It could go up, it could go down. It usually, now it doesn't have to, but it usually runs kind of parallel to the Bank of England base rate, but at a higher level, although they can fluctuate massively. So do bear that in mind. The lender can kind of take control of that and change it as they please. So a positive is that there is often no early repayment charge, ERC, which is a positive to doing a standard variable rate. The other type of variable mortgage is called a tracker mortgage. So this does actually follow the Bank of England base rate at an agreed percentage above it. So it's way more predictable, unlike the SVR that we just talked about. So for example, if the base rate, let's take it as it currently is at 0.25%, if the tracker mortgage was set at the base rate plus 1%, it would be 1.25%. And if the base rate then increased to 0.5%, then the tracker mortgage would do exactly the same, and it would increase to 1.5%. So generally speaking, the longer the term of a tracker mortgage, which is usually between 2 to 10 years, the higher the percentage above the base rate is, if that makes sense. I hope this all makes sense. This is what it's here for. So that's briefly covered fixed standard variable rate mortgages and tracker mortgages, as well as mortgage terms, fixed rates, and LTV, loan to value. You've got it. So what is remortgaging then? When you hear people talking about remortgaging, now I'm going to cover this properly in another video because I don't want to overwhelm you with information. These are supposed to be little bite-sized pieces, little bite-sized tips. So I will cover that in a separate video, but to very quickly cover it, basically, it's if you're moving your mortgage from one lender to another lender. Usually if you're coming to the end of your fixed rate term to get a lower interest rate, or if you're planning to borrow more money against your property. But like I said, I'm going to cover that in a separate video at another point. So finally, what about any other fees? You might be asking, if you've got to think about loads of other fees when you actually come to buying a property. Again, we'll cover that in another video, but fees when it comes to mortgages, yes, you might need to think about and budget for the following. So I'm going to give you some very rough averages so you can kind of get an idea of what these things would cost, because again, I would have absolutely no idea 10 years ago. I wouldn't have known what any of these things, even an average, would have cost. So hopefully that's helpful to you. But again, this is not, don't take this word for word. So just to give you an idea. So things that you might have to think about to do with mortgages and other budgeting things. Okay, so product fees for taking out a mortgage in the first place with the lender. Some don't charge, but it could be a couple of £1,000s, again, depending on the mortgage. Some of them don't charge. A lot of them don't charge. But yeah, some of them do, and it could be up to a couple of £1,000s. So again, that's something, if you went with a mortgage broker, they'd be able to talk you through that. If you looked at the comparison sites, they would list that as well. Sometimes there's an application fee for actually applying for a mortgage, whether you decide to take it or not. That could be maybe a couple of hundred of pounds. Valuation fee, that's where the lender carries out a valuation of the property to kind of confirm and clarify the price of the property and the value of the property. That all really depends on the value of the property, but again, I'd say it could be anywhere between kind of £500 to £2,000, just to kind of give you an idea. There's something called a telegraphic transfer. Now, I don't know if I've ever heard of one of these, but there we go. A telegraphic transfer fee for the lender to send money. That usually goes to your solicitor. That may be not too much, about £100. Probably not even that. I'd say £25 to £100. That kind of, you're not looking at too much there. And then mortgage broker fees, if you decide to use a mortgage broker, which like I've said throughout this whole video, I would recommend. Some will take a commission from the lender for using their product. They might charge you a flat fee for doing the work, or they might charge you a percentage of the loan value. I definitely recommend getting a mortgage broker though. Prices obviously can vary depending on that loan value. And I'd say you're looking at £500 to £1,000 is probably what you'd be looking to pay your mortgage broker. So there you go. Other purchasing fees for obviously buying a property will be in another video along with the buying process. I'm going to do a video on buying process, the renting process, whatever you're looking to do. So there you go. Oh, there's the bell. But don't run off just yet, okay? Because it's test time. I did warn you. I gave you little clues throughout this whole video. So let's see if you have been listening. So this week's question is, what do the following acronyms stand for? LTV, ERC, VR. What do they stand for? There you go. Have a little think about that. Now, whilst you're having a think about those, here is the answer to last week's quiz question. Last week's episode was all about securing a rental flat in London in this very difficult market, which is mad. Go and have a watch or a listen to that if you want to find out more about the London market or you're trying to tackle it, because hopefully that will be helpful. So last week's question was, what was the reason for the difficulty in the London lettings market right now? Was it high supply and low demand, or low supply and high demand? It was indeed low supply and high demand, meaning that not a lot of properties were on the market, but loads of people were looking. So that obviously causes an issue there, and just basically people competing to find properties. It's quite a nightmare at the minute. But yeah, if you're looking to rent in London at the minute, go and check out that video because hopefully there will be some little tips for you there. So very quickly to recap today's lesson, what is a mortgage? We learned that in short, a mortgage is borrowing money from a lender to be able to buy a property, either paying the money back on a repayment, which is paying off the borrowed money and then the interest on top, or an interest-only mortgage over a number of years. We looked at the average there being 25. Interest rates vary and often are set based on the Bank of England base rate, which as of December 16th, 2021 is at 0.25%, plus a percent on top from the lender, depending on the type of the mortgage and any initial fixed term that it might have. So there you go, a little roundup. I hope that all makes a lot more sense to you, and obviously wishing you loads of luck with getting your mortgage if this is why you're watching that video. Yeah, my number one top tip is get a mortgage broker or a mortgage advisor. I just think it's so useful. It really is. Yeah, as always, any questions or other kind of property topics that you would like to see covered here at Property School, raise your hand and ask, or AKA leave a comment. Catch up on any of the other episodes that you might have missed on IGTV, YouTube, or wherever you get your podcasts. So I will see you next week. Class dismissed.